Oye, como va? Look at, dude, you can't see this, Mike. The chat is going nuts right now. Everybody's here. People are so excited. Ladies and gentlemen, welcome to an all-new edition of What Are Your Thoughts?
I
wasn't going to go that slowly. Brought to you by the Compound Network. My name is Downtown Josh Brown. For those of you who are listening or watching for the first time, with me as always, my co-host, Mr. Michael Batnick. Michael, say hello to the folks.
Hello, audience. And everyone else.
Oh, look at you.
The whole everyone.
Guys, we have a lot to get to as the market rockets toward all-time highs, and I want to make sure we don't do anything short shrift. So let's mention the sponsor, and then we'll get rolling. Oh, sure. Actually, you know what? There is one thing I have to do.
Okay.
Do the sponsor, and then I'll do the thing that I have to do.
Okay. Today's show is brought to you by Rocket Money. Josh, listen to me? Do you have on your Gmail? Do you have like a primary tab and then promotion and updates?
I have four different ones.
Okay. What's the social one? Nothing comes in there. So my updates tab, that's where shit goes. It's the primary updates. And my updates, it's mostly, things that I just ignore.
Social is like so-and-so liked your post on Twitter or something.
Okay. So the one thing that I check every update is Rocket Money. You know why? For example, I got one today. Refund detected. Oh, amazing. Thank you, my wife, for returning something at Bloomingdale's. Rocket Money is an app that I use to help me track all my personal financial stuff, my subscriptions, what is going to be paid this week, next week, what's on auto pay. If you lose a credit card, oh no, everything's linked. Boom, right there. It's got you covered. I can cancel unwanted subscriptions, of which I have many and which I have done, directly through the app. Go ahead, Josh.
Is that a Malik Neighbors shirt? They have those out already? What do we
won
going? 2 games this year?
It's my only chance. We might not win another.
Michael, did you know Rocket Money has over 5 million users and has saved a total of $500 million in canceled subscriptions, saving members up to $740 a year when using all of the app's features? Did you know that?
Now I do.
Well,
Thank you
it's
for telling
true.
me. Okay.
Call to action. Go to rocketmoney.com/compound to stop wasting money on things you don't use. rocketmoney.com/compound. Okay, I do have to announce this. We're doing a giveaway. We have this incredible chart pack of what happens when interest rates are cut. A lot of great detail about what you could expect in this interest rate cutting cycle. Stuff that really only goes to clients or has gone to our clients first. We wanted to make this available to anyone who subscribes to the Compound Insider. So that's you guys. The Compound Insider is a really cool thing we do. We put out a lot of behind-the-scenes stuff about what goes into the shows, what guests are coming on next, etc. So it's free subscription. Please subscribe to the Compound Insider. There's a link in the notes below the show. And if you do that, we're going to send you a free copy of Callie and Chart Kid Matt's incredible interest rate down cycle chart pack. Is that the right way to explain what it is?
It's phenomenal.
So good, right?
Yeah, it's so good.
It's really good. All right, so if you want a copy of that, that's how you get it. Okay, I want to show you something Ari Wald put out. As I think, as usual, Ari gets right to the heart of the matter. The S&P 500 rallied above the July peak last week to a new cycle high. This is Ari. We continue to balance seasonal headwinds against our view that evidence of a major top is not compelling. We stress that market breadth remains constructive. Defensive leadership may represent a catch-up into previous underperformers, meaning it's not really leadership, it's just catching up. This week, I think this is like the main thing here. Ari is looking at the quality of new cycle highs, and he's saying we're therefore encouraged 200-day participation on the NYSE is again above 60%. So 2/3 of stocks are above their 200-day moving average. That's the sweet spot. You don't want to see that at 90 because that's the top, but you don't want to see that at 30 because that tells you you're in a really hollowed out market. This really looks, I don't use the term Goldilocks, but if you're making a new high, this is what you want market breadth to look like, which it doesn't mean it can't be a top. It just means that's not historically a sign of a major top. Last thing on this topic. Basically, the idea is that even the laggard stocks and sectors are now rallying, and that historically has not been a negative sign for markets overall. There's one more chart, Mike, I want to get to, and then I want to hear your thoughts on this. This is Ari. One concern has been the breakdown in interest rates and market leadership, represented by the high beta versus low volatility ratio. It's notable that this change in leadership was catalyzed by a breakout in low vol rather than a damaging breakdown in high beta. We'll be watching if high beta can reclaim a leadership role over the coming weeks. Overall, the rollover in leadership is a yellow light, balanced by positives elsewhere. So basically he's saying it's not that all of a sudden high beta is rolling over and getting killed. It's just that the low vol trade, which has been asleep, is starting to come alive again. So again, this is really like its participation is the important thing. And you have a lot of stocks working for a lot of different reasons. You have the stocks that work because of earnings growth. You have the stocks that work because of international strength. Now you have the stocks that work because rates are coming down. There's just a cornucopia of positive drivers for lots of areas of the market. And I think Ari put that really well. Michael, what are your thoughts?
Now, Chinese stocks as well, now providing a tailwind to certain areas of the market. A lot of the cyclicals were on fire today.
Yeah, I bet you didn't have that on your bingo card.
I did not. Here's what I have to say about the low vol worries in particular. Assuming he's using Invesco's low vol ETF or that index, let me give you the breakdown of the sectors, lest anyone think that these are like super defensive names. 23% financials. I would argue that you want financials leading into a bull market. We haven't had that in a long time.
And those are not defensive.
Those are not defensive. 15% consumer staples. So, okay, I'll grant you Coca-Cola, Procter & Gamble. Yeah, stapley as staples get. But then 15% are industrials. Like, what else do you want to see participating in a bull market if not industrials? And then 12.5% are utilities. But guess what? This is not your grandfather's utilities or your grandmother's for that matter. These are utilities that are being driven by the build out and the AI data centers and all of the electricity that they need. So
yeah, these are bubble utilities.
So this is not that. And Josh, I brought some charts of my own via ChartKid.
I'll be the judge of that.
Okay. So what we're looking at here is the first half versus what the second half. S&P 500 constituent returns. And what you would see is that the first half of the year, on average, the average stock was up 5.4% against the index was up 14%. Okay. So again, through the first half of the year, the average stock was up 5% while the index was up 14%. So the average stock lagged dramatically, which we'll get to in a second. For the second half of the year, the average stock is up 8.4% against the index, which is up 5%. So it's a complete reversal of what we saw throughout the first half of the year. One more chart showing this story. So ChartKid broke down, again, the first half versus the second half return. And only 7% of stocks were negative in the first half and are negative in the back half. 32% of stocks were negative in the first half and are playing catch up, are now positive in the second half of the year.
Yeah, look at that.
So that's a lot. The broadening out of the market, what more could one man ask for?
Yeah, I think that's a really important point. And you know, if you're a portfolio manager and you're underweight the market, you're underweight US stocks or any stocks, and you're reporting so we got October coming up. So you're going to report to whatever committee or board that you report to about what you're doing, what your allocation is, what your performance is. You could totally go to that body of people and say, look, I'm sticking to my guns.
The election's
We're
coming
underweight
up.
stocks. And the main thing I want you to know is we're underweight stocks because this whole rally is being driven by Apple, Microsoft, Google, NVIDIA, and I'm not chasing those stocks. That was what people said last year. You can't say that this year. There's too much strength in too many places. So you have a much harder time convincing the people you're managing money for to sit out and to stand by. It's really hard to do it right now. in a way that it was much easier to do it last year.
Correct.
You have a very legitimate case to make. It's like, look, what do you want me to do here? You want me to chase fucking NVIDIA with your money? Is that really what you want me to do? That is not now. NVIDIA is still the best performing stock this year, I think, in the S&P. But still, there are too many other stocks that are up 30, 40, 50% that have nothing to do with AI. And it makes it harder to not get involved here.
The only thing that you could say to your clients if you're underweight, because if you're bearish in a bull market, you're fired eventually. The only thing you could say is, listen, you really want to get all bulled up during the election. It's the only thing you could say. It's the only thing you could say because the broadening out of the market, the broadening out of the rally is looking really good. Speaking of, I'm not a victory lap, pat myself on the back type of guy. However, we have been pretty consistently saying, especially during the first half of the year, when the market concentration was very narrow, the line that we were saying was, listen, it would be one thing if the market were rolling over and it were only 6 stocks that were holding everything up. But that wasn't happening. Yeah, the rest of the market was going sideways, but it wasn't rolling over. We would have called it out if it were. We said what's more likely to happen is the rest of the market catches up. And here we go. So more charts.
We did say that many times.
More charts from Chart Can Matt. So this is the first half of the year through the end of June, okay? And what you saw was the index was up 14.5%. 4.4% of that was coming from NVIDIA. And the other 495 were only up 5.7%. Very unusual. Yeah. Very, very, very unusual.
And very narrow. And a very good reason to say the rally is fake.
Yeah.
It's all NVIDIA.
Yeah.
And a lot of people did say that.
Yeah, it was fair. Okay. Can't say that anymore. Next chart, please. Now look at the other 495 MFer. Now look at them.
Yeah, what are you going to say now, tough guy?
Yeah, 11.5%. And the contribution from NVIDIA has shrunk. From every other stock, it's shrunk. And the other 495 are playing catch up. One last chart. We've got the distribution of year-to-date returns bucketed out. And there's a lot of negative stocks, sure. But look how many, there's 121 stocks that are up between 20 and 40%. There's 39 stocks that are up between 40 and 60%. Yeah. It's not just the AI trade. I mean, it's a big component of it, sure, but there's a lot of things that are working, a lot of things.
I think if people were to see the ticker symbols, not that we need to do that now, put the chart back on, please. So the bars were showing you like the numbers. So if Michael says 121 stocks are up 20 to 40%, which is greater than the S&P's return of 19 and change, right?
Yep.
So, and then another 39 are up 40 to 6%. So like 160 S&P components are up somewhere between 20 and 60%. That's one thing. But dude, if I start telling you the ticker symbols, if I just go down the list Sean Russo and I keep, and I tell you the tickers that are on the all-time highs list, like it's undeniable that this is as good of a bear market as any bear market we've ever been in. Bull market. As any bull market we've ever been in. Like there's not like a better bull market than this. You might not like how it started. You might not like that it started as, GPUs or nothing, but like that's just not what's happening right now.
What's in your screener?
People get it.
What's in your screener with Sean?
All good stocks. All good stocks.
I just wanted you to say it's proprietary.
Well, it is.
I'm just looking at the year-to-date returns, and there's a lot of names in here. There's a lot of names that are up a lot.
So I think when you look at not just the companies that look of stocks that look really good right now, but just like the sector groupings of those companies belong to. It's really hard to concoct a narrative that there's something artificial or unwholesome. So think about it. Corning, Extra Space Storage, Ingersoll Rand, Kroger, General Mills, NASDAQ, Cummins. None of these companies
what are you reading?
L3 Harris, Royal Caribbean, Dr. Pepper. None of these companies have anything to do with each other. I'm giving you property. I'm giving Simon Property Group, Hilton, DoorDash, Fortinet, D.R. Horton, Newmont. I'm giving you gold miners, supermarkets, tech, soda, You know what I mean? Like, there's nothing narrow about it. You've just got companies with different drivers all rallying at the same time for different reasons.
What's wild, Josh, is I'm looking at the S&P. I'm on Y charts sorting by year-to-date return. The best performing stock is Vistra. It's a utility company. Of the top 10 stocks year-to-date, the only two that are in tech are NVIDIA and Palantir. Then you've got industrials, utilities. There's an energy stock in here, and real estate. And then he's got some
that
financials.
Vistra thing is involved in the AI is involved in AI build out for utilities.
Yeah, so there's
It's
a
like
lot. Listen,
it's like some kind of an energy thing.
we said no signs of a top. It's not to say that stocks won't go down eventually, but come on, man. What are we fighting? Everything's working. Won't always, but for now it is.
Right. Okay.
And now we've got
100%.
Chinese stocks
And
exploding.
that's the message that I wanted to bring out. Let's talk about Chinese stocks. When was the last time we did? Could be over a year. It's been nothing to say. It's been a relentless bear market for Chinese stocks for 3 years.
Yeah.
So here's what happened today. This is This is the lead paragraph from a Bloomberg piece. First, he took a sip of tea to gather his composure. Then, Chinese central banker Pan Gongsheng unleashed one of the country's most daring policy campaigns in decades, in what amounts to a massive adrenaline shot for an economy on the cusp of a deflationary spiral. The governor of the People's Bank of China and other top financial officials unveiled a series of easing measures that market watchers had wanted for weeks at a rare high-level press conference in Beijing. They include interest rate cuts, more cash for banks, bigger incentives to buy homes, and plans to consider a stock stabilization fund. So Brendan Ahern at Crane Shares in his China Last Night newsletter that we talk about all the time said, monetary policy bazooka unleashed, which got me really excited. And dude, I got really excited. When you look at each of these things on its own is no big deal. It's the combination and the coordination. Not only is China's central bank doing this, but the financial regulators were part of this press conference. So it reminds me of what happened in the wake of the pandemic, or during the height of the pandemic, when Treasury and Fed came out of the joint conference with masks on, probably on Zoom, I forgot. But it's like, look, we're not playing games here. We're throwing the kitchen sink at this problem. So I don't know if this is enough to put a bottom into the Chinese stock market, but if it did, it would certainly make sense. So you got a huge reaction overnight. The Hang Seng, which is Hong Kong's market, and the Shanghai Composite, which is the mainland's market, both gapped up and closed 4% higher and change. The K-Web ETF went bonkers. I think it was up 8 or 9% all day today in New York. And I wanted to just maybe go through a couple of these items, because if you were trying to put an end to a deflationary spiral, this is pretty much how you do it. Number one, the Fed cutting rates gives China the ability to cut rates. Remember, there's a currency peg here. So China can't really act as unilaterally as they might like to. So the RRR, which is their equivalent of the Fed funds, will be reduced by 50 basis points, with another cut of 25 to 50 basis points at an appropriate time, probably right after we do our next cut. This gives banks another trillion renminbi to lend. 7-day reverse repo rate was cut by 20 basis points to 1.5%. This rate determines the medium-term lending facility and bank deposit rate. This is basically the cost of money amongst the banks. Existing mortgages were reduced by 50 basis points, which will benefit 50 million households or 150 million people. The total annual interest rate expense per household will be reduced by 150 billion yuan. They cut the minimum down payment ratio for first and second mortgages by 15%. What else did they do? To support affordable housing. They are providing $500 billion to brokerage firms, mutual funds, and insurance companies to buy mainland listed stocks and ETFs. This is nuts. Here, go buy the stocks of the market. They're telling commercial banks to provide loans to listed companies and major shareholders for the express purpose of doing buybacks and increasing holdings of listed company stocks at a rate of 1.75% interest. So effectively giving them like an interest-free loan to go fund buybacks. Last one, they're increasing tier 1 capital for the 6 largest banks. So they're basically like giving the banks more money to hold on to. If you were trying, and then there's a whole lot of other stuff here, loans for small businesses, blah, 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 encouraging venture capital, encouraging private equity. They're basically saying, wake the fuck up, stop selling stocks, and let's put a bottom in this thing. So it could fizzle out. I don't think it will, because this is a command economy, and when she wants something done, it gets done. May not always work out in the end, but like I feel like if you were trying to change the story and the narrative, this is the way you would do it. And they did it. And we watched the Japanese do this already, and we know it works. So what do you think about the bazooka?
This is a lot more than just monetary policy, right? To all the things that you just read. And if this doesn't work, I would say that China's going to zero. So let's hope that it does work. There's no China bulls. Maybe there are. I don't know any. The Chinese stocks are trading at 9 times earnings, as well, about as low as they've been ever. As well, they should. They deserve all the discount that they've been getting. The property market is in shambles. Like shit is going on, so they deserve the discount. But if this, this is bigger than just the Chinese economy or the Chinese market. This is obviously a global superpower, and I did say early in the year, like just as a not serious comment, like what if China isn't going to zero? Like what if there's any whiff of a positive catalyst out of China? What would that do? So today was a big time outlier for emerging market stocks relative to the S&P. Chart Matt stepped up. Emerging market stocks were up like 3% or so. The S&P was up 20 basis points. Chart on, please, John. So this is the chart of the one-day return of the S&P versus EEM. This is a bit hard to see given that there's, I don't know, thousands of data points in here. So why don't we zoom in a little bit closer? Why don't we zoom in a little bit closer? We zoom in.
Okay.
There it is. So
why would we make a chart like this? Why would we do a shotgun chart to just show 2 indices? What am I missing? You
don't get chart art. This is art, okay? We're showing the return, the daily return of the S&P and EEM. Mm-hmm. And up and to the right, there's a highly positive correlation, obviously. Most of the time, they move in the same...
I lost...
What? My audio?
I lost your audio, Mike.
You lost...
Guys, chart off.
You lost my audio. My audio?
Oh, now I have you.
Oh, back
now
on.
I have you.
Chart back on.
All right.
So this is the one-day plot. And again, most of the time, they move pretty tightly. But what this is showing, Josh, is the S&P was flat today. Okay?
Yeah.
You see that? The y-axis S&P was flat. Look at EEM.
Yes.
This is, it looks like the largest outperformance day for emerging markets when the S&P was flat. So this is a big, big deal.
You guys, Mike is cutting in and out. Mike is cutting in and out for me. I don't know.
For you? Is it just for you?
I don't know. I can't tell.
Let's go to the Slack. Duncan, somebody Slack me. Tell me what's going on here.
All right.
All
you're like buffering a little.
Well, okay. Duncan's saying that we can hear both of you that whole time. So,
so it might be me.
Close your shit.
Okay. You're right. I think I have everything closed.
Okay.
You could always close more.
Anyhow, today was a big day. Today was a big, big day for stocks. Next chart.
I wanted to ask you about the Crane shares chart. Can we put that? Is that where we're going next?
Go ahead. Next chart.
All right, cool. All right. I mean, this is an incredible single day for one sector of the Chinese economy.
This is a move.
It's a move, dude. Yeah. So in my opinion, this is not the kind of thing that fizzles out. I see it as the starting gun, and doesn't mean they'll fix the Chinese economy in one day, but sometimes you have to fire a gun to change the narrative and to wake people up. Mm-hmm. And I want people to understand the backdrop of something like this. So the backdrop is the Chinese stock market has seen $6 trillion wiped out since the highs in 2021. It is the worst major stock market in the world coming out of the pandemic. They had their own 2008, 2 years ago. They blew up their property sector, which was a huge speculative bubble in commercial property. And that has led to disinflation and outright deflation all over the economy. And their economic ministers are now panicking. Remember, I said it's a command economy. You know how the Chinese economy works? They ask President Xi, what's the economic growth rate going to be this year? And he says 5%. And they say, wow, you're right. It probably will be 5%. And then miraculously, it's 5%. They're like falling short of that 5% GDP goal. And nobody wants to fall short of anything that the Communist Party tells you is supposed to happen. So they are pulling out all the stops. They still have a lot of constraints that they could loosen up. They have this thing there where debt can't go above 3% of GDP. Like they have like a lot of like these old rules in place that maybe were more useful at a different time. I don't think they're out of levers. And I also think culturally nothing pisses them off more than seeing what Japan is doing and being left out. So there's a lot of factors behind the scenes here that probably led to this decision to do this. Let's go through some of these stocks. And again, I feel like it's been forever. Baba did 12% today. Alibaba is 11% of KWeb. Tencent did 6%. It's 11% of KWeb. JD.com went up 37% today.
What?
Did you hear me?
37?
Pinduoduo did 11% today, and that's 6% of KWeb. So we're looking at something fairly notable, and even in the United States,
It's bigger.
Freeport-McMoRan was the top performing stock. This is the company basically mining all the copper for whatever China's going to build next. It was the best stock in the market today. It went nuts.
Metals and mining, XME up 4%. Industrials all-time high. Materials all-time high. Caterpillar all-time high. This is bigger than just China. So if you need another reason to get constructive on the market, I don't know what you're waiting for, but there's the backdrop is favorable. VIX is at 15. It's all happening. All right. Anything else to say here?
No, I just think it should be on people's radar that this is a big surprise, potential positive catalyst.
Not priced into
anything. Nobody was thinking about.
In fact, the opposite of priced in. It was priced out.
Yeah, it was a negative.
Yeah.
And now it might not be a positive, but at best it maybe is a neutral, and that changes the equation a little bit. So.
Okay. So, Josh, I want to talk about private markets. I read an article. The opening was, when the facts change, I change my mind. What do you do, sir? That probably fake quote is attributed to John Maynard Keynes, and that this article, the title is When You Should Invest More in Alternatives, written by Larry Swedroe, who is, in my estimation, one of the more important people in terms of pushing asset allocation, proper asset allocation in the wealth management industry forward. I don't know if pioneer is probably too strong of a word, but he was very much an asset allocation guy, traditional asset allocation. Private investments were not necessarily something that he was synonymous with. So to see him put this out there got my attention. So let me read you Larry's words. Larry wrote, 16 years ago, when my book, The Only Guide to Alternative Investments You'll Ever Need, The Good, the Flawed, the Bad, and the Ugly, was published, my own portfolio included no private investments, and it held only one investment, commodities, that would traditionally be considered as an alternative. He then goes to say, today my portfolio has an allocation to alternatives that is in excess of 50%, including exposure to life settlements, reinsurance, private credit, private real estate, drug royalties, litigation finance, long-short factor funds, and private equity. What led to such a dramatic change in my personal allocation? Financial innovations in the form of interval funds and increasing competition have dramatically improved the opportunity set for retail investors. This, in my estimation, is going to be one of the biggest stories in wealth management for the next 10 years, is the deliverance of less expensive, truly diversified, less pain in the ass, better tech, better wrappers to individual investors. And I'm certainly not saying it's all going to go right or every client is going to benefit from this, but it is coming. I have no doubt about that.
The good news is all of these alternative funds will only disappoint at roughly the same rate as actively managed funds have disappointed.
I don't know about that.
They won't be worse.
I don't know about that. I think
no, because Mike, you'll have a category return, and then you'll have the same amount of funds underperform the category. just as though we're talking about small cap value or large cap growth. It won't be any different. You'll have a peer group.
Oh, it won't
One
be
or
different.
two will look
it will
great.
be different because no investors can't own an index of private investments.
No, you're missing it. It's
Go
not
ahead.
an index. It's a peer group. So, all right. If I tell you I'm a large cap stock fund manager, you could judge me against two different things. You could judge me against the S&P 500, which is the benchmark index, or you could judge me against all of the other large cap stock managers. Mm-hmm. In private credit, there's no index, but there's a peer group. So my point is, you'll have a few standout performers in the peer group, and everyone else will suck. And there's no index, but there's still a benchmark. The benchmark is all of the other private credit funds. That's all I'm saying. And the disappointment will be no better, no worse than it is in stock market land. It's just a different benchmark that you'll judge it against.
Yeah. Okay. In 2020,
No?
I don't know. It depends what's going on in the market. That's a blanket statement. You can't make that statement.
It's not a blanket statement. This is how the hedge fund world works.
Who said anything about hedge funds?
That's what this is, though. It's hedge funds for retail.
These are not all hedge funds. Absolutely not.
Private equity fund for retail. That's what it is. Interval fund is a retail private equity fund.
Yeah, this is not hedge funds, though. These are not.
But my point is, no, you're not listening. Nobody judges private equity, real private equity, against an index because the index doesn't exist. It's peers. So when they're saying like, who did better this year, KKR or Bain? It's a peer versus a peer.
Okay.
That's how these funds will be judged because there is no index. They'll be judged versus the other options in the same category, peer group.
Okay.
That's my point. So when you said, I don't know if this will work out forever. No, of course it won't. But I also don't think it'll be materially more disappointing than selecting a large cap value fund might be. Just as disappointing. Some big winners, lots of mediocre, and then a couple of big losers.
Okay.
It's just,
BlackRock.
I can make that blanket statement.
Well, it feels like a little bit of a non sequitur, and also a little bit of goalpost moving.
I stand on that. I guarantee it.
Here's from the Journal. BlackRock plans to offer wealthy investors a way to access areas such as private equity and credit. And they're joining a partners group to create a so-called model portfolio that wealth advisors could use to help clients invest in a variety of private market offerings. The head of global client business at BlackRock said, there's currently a zoo of documents for financial advisors who know they should be doing more in private markets but don't know enough and frankly are a little worried about using individual products. So BlackRock is making a push here. My point is, disappointment aside or not, this is coming. This is going to be one of the most discussed trends in wealth management for the next decade because they are going
I totally
all
agree
in.
with you. I totally agree with you. And of course, the seeds of that future disappointment are being planted today when you create a model portfolio, you're creating funds that are about to get gigantic. And what will end up happening is none of their historic returns will be valid ways to think about the funds anymore because, of course, an alternative fund managing $500 million is going to be doing things very differently than when it has $5 billion in it or $50 billion in it.
For sure.
So you'll have, look, the banks all did this. Like Highbridge was bought by JP Morgan. Highbridge was like a really high quality alternative asset manager. I'm sure they still exist. I'm sure it's great. But my point is, once you allow something to get on a platform like that and the money floods in, it's just impossible to perform the way that you used to because you're too big. So you need gigantic opportunities. You can't do the smaller trades that were super profitable at smaller AUM levels. So, you know, this is not very dissimilar if BlackRock or any other giant asset manager anoints a group of 8 alternatives, like the best one for each category. They might be right on the historic data. The problem is those funds are going to start behaving differently. They're going to have more investors to deal with, more money to put to work, and they won't look anything like their former selves. And this is the blessing and the curse of success in the alternative markets. You can't remain what you once were once you've been discovered. and everyone knows who you are.
Well, returns
So-
returns will be lower than they were historically. How could they not be with so much money coming in? But guess what? The marks will remain unmarked, and that is a big selling point for these things.
What do you mean the marks will remain unmarked?
The illiquidity of these things is going to remain. Now, there's somehow stuffing some of these things into ETFs. That will not probably end well. But these things, whether there's $1 billion or $1 trillion, they still don't trade, right? These loans don't trade. They don't trade. They're loans, for example.
Yeah, they trade by appointment. You like literally need to find somebody to transact with you, and so you can go a very long time without knowing what the value of it is. So you have to rely on the committee that's setting the marks and the price. Like you have to really believe in the company that's offering the product, and easier said than done, and easy in a bull market. So in a bear market for credit, I don't know. Like, are people going to be thrilled that they ran into alts at the very top of the interest rate cycle? Look, it's.
You know what? I wouldn't be surprised if in a bear market more money comes in because you're going to see all the marks of your liquid shit.
You know what's the best? Yeah. You know what's a great alt? Like a vending machine route. You know what I'm saying?
Great alt.
Like
I agree.
No outside capital. Just
throw
get
that,
yourself, like,
dude. Throw that in an
get yourself
ETF.
a few hundred vending machines. Yeah. So all right.
Throw that in an
I agree
ETF.
with you. Can we put the pie chart up so people understand what we're talking about? These are all the different categories that fall under.
This is private credit.
Private credit. So when you hear people say private credit, it's not monolithic. There's lots of different flavors of this marketplace. So you think like wealth managers are going to go deep in the weeds and have different solutions for each one of these?
No,
or
there's
will
going
most
to
people default
no.
to-
There's going to be model portfolios like what BlackRock is doing.
Yeah. So you could say like, all right, this is the private credit sleeve. We'll put $1 million of a $10 million portfolio into it. And then inside of that sleeve, all of these slices will be represented by like a model portfolio.
So I am mega bullish on this trend. Don't misunderstand me. I'm not saying that this is going to work out for every investor, but this is where the puck is going.
I think that the way to play this is not to buy private credit funds. I think you want to buy the 6 or 7 publicly traded private equity companies if you're bullish.
Well,
if
I own
you
2 of them.
Okay, so what are they? KKR, Blackstone, Carlyle Group, Fortress,
Apollo.
Apollo is public.
I own Blackstone and Blue Owl for what it's worth.
Yeah. I would rather build a portfolio of those and almost act like a GP, taking in the fees from all the people that are trying to figure out which private credit fund to buy. Because I'm smarter than the average
problem
bear.
with that is the stocks trade every day, but that's what I'm doing. All right, let's talk about Zuckerberg.
Right. If you really think the most valuable piece of this thing is the illiquidity and the fact that it forces you to not move your money around, I don't believe that that's like the most valuable part of this. Is that what you really believe? Like that's the real benefit?
I genuinely do. Yeah.
Really?
The fact
Okay.
that you're not allowed to panic sell, I think, is a huge benefit. And I guess
I don't think it's a negative. I just don't think that's the source of the returns for the asset
No.
class.
I think there could be an illiquidity discount. How about that? You pay them to not show you the marks. I don't believe in the
All right.
premium of it.
So then why can't I just invent a mid-cap growth fund where you sign a document saying that you're locked out of it for 5 years? I bet you I beat the shit out of your fund of alt funds.
I agree. I don't know if Meb tried to do that, but people have tried to look into the structure of sort of forcing you to buy and hold, and I don't think legally you could do it.
All right, we have more to say on that, and we could talk about it another time. I asked you to listen to the Acquired podcast with Mark Zuckerberg. Did you have a chance to do it?
I was supposed to do that? Yes,
Yeah.
I did.
Okay. Did
The
you
whole
like
thing.
it?
I loved it. Fucking loved it.
I like him more and more the more I hear him these days.
You know, remember the days...
I was never a Zuck guy.
Well, because he was a dork. He was dressed in the same shirt every day so he didn't have to make decisions. Now this motherfucker is a designer. He's designing his own clothes.
Your clothes are hideous. But I like that he's like, I'm not going to apologize anymore.
He's coming
he's like,
across
look-
as a human. He's talking.
Yeah. And I just ranted about Meta 2 weeks ago about how they're not protecting users from crypto scams. Like, I don't like Facebook, and I don't actually think it's a force for good in the world. I actually think it's the whole concede is fairly toxic. But I like the kid because the kid is like, I think we got scapegoated for a lot of things that weren't really our fault, and I just was trained to keep saying I'm sorry, I'm sorry, I'm sorry.
Yeah.
And he's
over-apologized.
He's going to stop doing that, and I sort of respect that. So the acquired guys had him on stage at the Chase Center, and a couple of takeaways for me. But let's maybe play this first.
Phone before replaced it with a smartphone, and then a lot of more people got smartphones. If all we get is all the people in the world who already have glasses upgrading to glasses that have AI in them, then like this is already going to be one of the most successful products in the history of the world. So, and I think it's going to go a lot further than that. So I know there's that. There is the thing about controlling our own destiny. It's strategically valuable. You know, we did this calculation or estimate at some point where it's like, how much money do we lose from our core family of apps to the various like taxes that the platforms have, to like when they tell us we can't run the ad business the way that we think we should be able to, when they tell us we can't ship certain products so that way like people use the things less or like them less. And it's hard to exactly estimate it, but I think we might be like twice as profitable if we own the platform or something. So I think from that perspective, that's worth a lot.
Good, Paul.
So for me, that was really the most important part. He thinks that Meta would be twice as profitable if they owned the ecosystem rather than rented a space on it. Meaning, if Apple, iPhone, and Google's Android weren't like siphoning out a huge chunk of the profit. Remember, the iOS store extracts 30% of the revenue from all the apps on it.
Dude, every time I buy a t-shirt on Instagram like this one, Apple's getting paid.
Yeah. And then they also dictate the terms and what your apps can do. So if you own the hardware and the platform, you don't have to follow what Tim Cook says. So the big takeaway for me is that this Apple iOS dominance drives Zuckerberg up a wall. I think it's the thing he's most animated by. He thinks he would be twice as profitable if Tim Cook didn't have him in checkmate via the operating system. And he might be right. So throughout the course of this conversation, I think it was an hour and a half or so, you can hear Zuckerberg repeatedly denigrate the iPhone and talk about how unlikely it is that we're going to be experiencing the internet on tiny screen. He keeps saying small screen, tiny screen. He hates the iPhone more than like anything in the world. He said, you're all suffering from a lot of recency bias in terms of like people thinking Apple is forever and Apple just like is automatically going to dominate the next wave of computing and the next wave. He's like, you just think that because that's what just happened with phones. But like that is not what's going to happen. And this is why he could justify spending $50 billion on Reality Labs and Oculus and Ray-Ban glasses because he is that desperate to own the hardware that's going to contain the next wave of computing. So let's say it's AR or, you know, virtual reality, augmented reality. He has to sell the hardware. He can't watch Apple run another lap around him. It's making him absolutely nuts. So that was my big kind of read between the lines takeaway. And then the other thing I thought was cool, just about podcasting in general. This is a major coup for the acquired guys, and I really like them.
Me too.
They had 6,000 people come to the Chase Center to watch this live.
Wild.
And Jamie Dimon did the video intro because JP Morgan Chase's payments business is a big sponsor of Acquired. So I thought that was kind of baller too.
I was shocked.
What did you think?
I was shocked when I saw Jamie come on screen. First of all, I watched it on my phone on the podcast, on the Spotify podcast app, which I love that you can watch it now live in the app.
Yeah, we don't know how to do that with our shows.
I thought it was great. They crushed it. I thought Mark was very likable. The biggest takeaway for me was this quote that I pulled. He said, I think there are a lot of conversations that we have internally where you're almost at the line of being embarrassed about what you put out because you want to put stuff out early enough so you can get good feedback. You obviously want to test things that are reasonable hypotheses. So if it's ineffective, then you're not testing a good hypothesis. That doesn't work. But I do think a lot of the conversations that we have are like, okay, we can get this to be a lot better if we work in it for another couple of months or whatever. I do think that what you really want to have is a culture that values shipping, getting things out, and getting feedback more than needing always to get great positive accolades from people when you put stuff out. If you want to wait until you get praised all the time, you're missing a bunch of the time when you could have learned a bunch of useful stuff and then incorporated that into the next version that you're going to ship. End quote. Now, I think for this, it's a fine line of, yes, you want to always be shipping, like move fast and break things was their mantra, but you can't put out shit, right? And we've seen that a lot with some of the wealth tech companies that we use. It's like, come on, you're not even close to ready. Don't do this. And there's a line where you have to find between being perfect and, all right, this is good, get it out, and we'll iterate from there. And I think they nailed it.
Well, I also think it's what are you doing? So if you're doing something where like cybersecurity is a big component of it, you can't move fast and break things because you could bankrupt your own company. But like iterations of Llama, which is Meta's AI code and language, like getting 1.2 out and then 1.4 out a week later, I feel like you can do that because people are giving more leeway to things that we all understand are experimental. So I think it's like a function of like, what are we talking about?
Totally.
I don't.
It's like if they're putting out something new on Reels, just it's not that serious. Just put it out, and if we get bad feedback, we'll fix it.
Well, right, because you have the ability to do an update over the air that night. You catch something, and most people at this point, I think, are set to automatically update apps. Most people will never even know there was something wrong with it because by the time they would notice, someone else has noticed and fixed it. So, look, I use Instagram. I don't use WhatsApp. I don't use Facebook. I'm not particularly a Zuck guy, but I thought that this conversation with the Founders guys was super humanizing.
Really good.
Daniel Ek popped out from Spotify at the event. Jensen Wang showed up from NVIDIA.
6,000 people.
Yeah, it's pretty. It's
really
I think
impressive.
It was a pretty cool moment for finance, business, podcasts in general. So shout to the Acquired guys. I'm really a big fan.
All right, let's talk about Intel. Intel got kicked out of the Dow, no?
Yeah.
Okay.
No, not yet. Or maybe it did. I don't know.
Okay.
I mean, whatever. It's a shell of its former self.
So chart on, please. This is just a Shonda. Intel was a top 3 company in the world in 2000 at $450 billion market cap. More than that, if you inflation adjust it, it's probably closer to $1 trillion. And it's now south of $100 billion. And if you look at the fundamentals, it deserves it. Next chart, please. Revenue peaked years ago. Free cash flow, it's just hemorrhaging. This is just disgusting.
Look at this. They're
Really-
negative 12. Is this quarterly or
This is I think this is trailing 12 months. It's really gnarly.
they're negative 12 billion cash flow
Really, really
on
bad.
12 billion in revenue?
It's not
How
great.
does this thing still have a $90 billion market cap?
It's not great. So there was talks yesterday that Apollo might come in for $5 billion in equity. The enterprise value of this company is like, I think $130 billion. So I don't know what happens here. It seems, I don't know the story. I don't know shit about semis or anything, but it just seems like a melting ice cube.
Well, let me tell you one thing that you do know.
Mm-hmm.
If Apollo is looking at you, you are in bad shape. That is like down and dirty. And if you take their money, you need it. Like that is.
Well, they got started as distressed debt investors, no?
This is distressed AF if you're talking to Apollo. So it's the more interesting rumor was the one over the weekend that Qualcomm is kicking the tires. There's an element to Intel where the United States government needs them to survive and thrive. They are our best hope at doing fabrication of chips by a U.S. company on U.S. soil. So there are other fabs that could build facilities here and talk about doing it. Taiwan Semis sort of doing it, but then like they cancel plans very quietly. They make big announcements, but then they like don't do it. Or maybe that's Foxconn. There's a lot of Asian companies that would like to find a way to profitably do what they do here for obvious reasons. Intel is kind of like a welfare queen. They're cutting ribbons all over the country in different states like Ohio, getting taxpayer dollars to fund the building of these facilities, but nothing ever really seems to come of it. And I know these are long-term projects, but nobody seems to be benefiting. And the stock price is just in a tailspin. I don't know. Is it great? Is it better if Qualcomm just like takes this thing over and turns it around? I feel like it might be. And Qualcomm's another U.S. company.
It's irony. Like Andy Grove, one of the founders of Intel, wrote a book, Only the Paranoid Survive, and it's like an iconic management book. I don't know when he wrote it, but it's timeless.
One of the other things is that like Qualcomm's sort of the anti-Intel. It's a patent company masquerading as a semiconductor manufacturer. They're not like doing manufacturing. They design chips, and they have incredible patents that are hugely valuable. Intel went the other way. They were like, oh, actually, we're going to make our own, and we're going to be a foundry for other chip makers that want us to make their chips. That was the big bet that they made like 2 CEOs ago, and obviously that hasn't played out. So I think it's interesting if Apollo does some sort of a big stake here. So like I don't know what that would look like.
But they were talking about only 5% of the company. So where does the rest of the money come from? That's a lot of money.
It's too big. It's $96 billion equity market cap. I don't know what it is, enterprise value. If you add back the debt, I'm sure it's enormous. I don't think anybody could do this deal. So like I think there could be a big investment. I don't literally think that anybody could buy Intel. I could be wrong. I don't even think it's worth discussing. So
all right, I'm gonna make the case for a company that I made the case for a couple months ago. But before I go there, I want to make this important case. Do not bottom feed in a strong market like this. If your stock
I totally agree with this take.
If there's a stock that you're looking at that's at a 52-week low, run. There's a time for bottom fishing. This ain't it. Everything is working, and if your stock isn't, there's probably a really good reason for that, okay?
Yeah. Strong take. I like
it. All right, let's talk about Sherwin-Williams, the number one paint company in the world. This stock has had just incredible runs since the 1990s. Chart on, please. It's returned 23,000 some odd %, just destroying.
Oh my God.
Just a monster winner. Why, you ask? Well, happens to be a really good business. Funny how that works. Next chart, please. On top, we're looking at the quarterly revenue, up and to the right. Underneath that, you're looking at free cash flow per share, up and to the right. Underneath that, you're looking at shares outstanding, down to the right, which is exactly what you want to see. I bought this stock when I recommended it at 345, next chart. And I was saying, listen, it's coming to an all-time high. That's the yellow is when I initially bought it. Probably, I don't know if it's the best time to buy it. You could buy it on the pullback. I didn't buy it on the pullback. I bought higher. I added at 361. So I don't know if now is the best time to buy, but that's the thing about good stocks. They don't give you a chance to get in. Next chart, again, similar to the last one. This just zoomed out a little bit. Stock is at an all-time high. And the reason why I'm re-recommending it today is because I listened to a brilliant conversation with Matt Russell, the CEO of Colossus, Patrick O'Shaughnessy's podcast platform, and Todd Bassnight is a director of equity research at Aureus Asset Management. And it was an incredible conversation, very enlightening for me as a shareholder. I learned a lot because, listen, I'm not a fundamental analyst guy. I'm looking at the charts. I'm looking at broader picture of, I believe in the secular story of housing. Way more buyers and sellers I don't need to overcomplicate it. But here's what I learned. Sherwin operates over 4,700 dedicated paint stores in North America. That's more than all the Home Depot and Lowe's combined. It's more than half of the dedicated paint stores in the country. Sherwin has 3,300 delivery vehicles with 3,000 drivers. So there's a quote. He said, so it is almost like the Amazon of paint. You can buy online, pick up in a store, call it in, pick it up, call it from the job site. They can deliver it to you. Sherwin estimates that they save their painters 1 day per month by delivering paint to the job site. So anytime the painter does not have to spend driving to the store, that saves them money. In 2023, the paint stores group, paint is like 65% of their revenue. The other 35% is coating. Paint stores group generated nearly $13 billion in sales. Over the last 10 years, they compounded sales growth at 8% per year. That's 6% same-store sales growth and 2% annual store growth. Those 4,700 stores generate $2.7 million per store. That's kind of nuts. $2.7 million per store.
That's like a McDonald's. That's like better than a McDonald's.
Higher than Chipotle.
Franchise. Yeah.
Higher than Chipotle. And they spoke about the competition between this and Benjamin Moore, which is a Berkshire Hathaway company. When you think about the differences between paint, if you talk to a professional painter, some like Sherwin-Williams a little better for this, some like Benjamin Moore a little bit better for that. When you think about them preferring
Is Benjamin Moore owned by Home Depot, right?
It's Berkshire.
Oh, it's Berkshire.
When you think about them preferring Sherwin-Williams by a margin of 5-1, it's not because the paint is that much different. It's because the service is that much different. So
This is such a great point that you're making. And like, when was the last time you walked into a Home Depot? I think it's the worst retail experience on earth right now. I think it's worse than Sears was.
I own Home Depot too.
Okay. Nobody can help you in that store. What they can do is point to the right aisle.
Yes.
They're too busy.
Yeah.
There's too few of them, and they're always on a fucking ladder. No matter what, they're always on a ladder, and they're not subject matter experts like they were 20 years ago.
Smock. Excuse me, where can
They don't know anything. They could be working at a Target. It's almost interchangeable. I'm sure there's a few people in each store that like really know stuff, but for the most part, they're just restocking shelves and they can't be bothered. This stuff matters because if you paint the rooms of your home, you're stuck with it. If you don't like it, you know what I mean? Like it's worth going to one of these 4,700 Sherwin-Williams stores if you're doing it yourself or with an interior decorator and really getting what you want. It's not a frequent purchase, but it's a purchase that matters so much that you're not like, how could I save 50 cents a gallon of paint? No. That's not the thought process.
So another thing that they said that was like, oh yeah, that makes sense. It's certainly not recession proof. Nothing is, but it's maybe a little bit recession resistant because painting your wall, it's not like a luxury renovation, right? During the GFC, Home Depot revenue went down 30%. Sherwin-Williams only went down 15%. Because again, if you could afford paint. It's not a
you might not be able to renovate your home, but you'll definitely feel better if you put a fresh coat of paint in the kitchen.
Exactly.
And that's exactly right. All right, this is a strong pitch. I loved it.
Thank you.
I have a mystery chart for you, Michael, and it's actually a throwback to a make the case that I did back in April.
I'm guessing it's going well.
It's going really well, so well because I didn't buy it.
Oh, I know what it is. I know what it is.
No, you don't. So I made the case on April 9th on the show. I didn't like go over the top like with all these details about it. I was just like, look at this stock making a new high. Let's go under the hood. Why is it working? Of course, I then completely didn't do anything about it, and I've been watching it ever since. And last week it just went bananas.
Is that the actual price?
This is the stock price, dude.
Okay.
The red line was the all-time high that I was pointing out to you on Make the Case. It hit the Russo list. I wanted you to know about the company. We talked a little bit about the company, and then that's it. And the rest was history.
Before I guess, start off, please. I want to look at you. Did you ever buy? Did you ever buy Arista Networks or eBay?
No, that's why they work. This is my new stock service that I'm offering free of charge to viewers or listeners of What Are Your Thoughts?
Okay.
I will tell you the best stock market setups, and I will give you my word that I am not going to buy them. It's a guarantee.
That's good.
It's as close as you get to. All right.
So
I see some guesses and some people in the chat.
You want to give me a sector?
Know what it is?
You want to give me a sector?
Tech.
Mega cap? Oh.
No.
Oh, not mega cap. All right.
No, Michael, the stock has doubled.
Okay.
It's not mega cap.
Okay. Any other clues? What do they do? Who do they compete against? What's the stock?
It's software.
It's software. Software that doubled, and I thought software wasn't working. Is this Salesforce?
AppLovin.
Oh, that's Salesforce is mega cap. My bad. AppLovin.
AppLovin.
What the fuck is this?
Yeah. I pitched it to you. They do app stuff.
AppLovin?
It doesn't matter. What matters is
it goes up. The stock goes up. Okay.
The stock went from 60 to 130 because 70% because I chose to not do anything with it.
Look at that total return. Very nice.
Sick.
Very nice.
Sick. That's in what is that? 4 months.
It's very nice.
So I'll give you the next stock I'm not going to buy.
Thank you.
On an all-new Make the Case.
I appreciate
next
that.
week.
Okay, I can't wait.
For those who want to tune in. Hey, guys, thank you so much for tuning into the live, and thanks to everyone out there in podcast land listening. We absolutely love it. We appreciate it. Make sure to leave us a like. And hey, everybody, did you know tomorrow is Wednesday, which means an all-new edition of my favorite podcast, Animal Spirits. starring Michael Batnick and Ben Carlson. We're going to have an all-new Ask the Compound at its new time. I think we tape those on Wednesday now. We go live to YouTube, right? Do you know about that?
Live to YouTube. Nope.
Ben and Duncan.
YouTube. Yep.
Yeah. Live to YouTube. I think it's on Wednesdays now. I'll double check that with Duncan. We're going to do Compound and Friends at the end of the week. Very special guest. If you want to know our guests in advance, sign up for the Compound Insider. And again, you'll be getting Callie's new interest rate chart pack for free. All right, that's it from us. We'll talk to you soon.